Hello everyone. In this video, I will introduce income statement. Just like the balance sheet, I will always introduce a common size income statement. So as we mentioned that the balance sheet is more like you take a picture at one time point. We want to know how many assets the firm has, how much of the what's the percentage of assets is from liabilities, and what's the percentage of assets is from shareholders' equity. For income statement, it's more like we wanted to know over a time period how many revenue we generate and how many net income we generate. We report the revenue first, then we deduct expenses for this period. And we all know income equals to revenue minus the expenses. Here, you should know that we have this so-called matching principles. So if you recognize the revenue, you have to record those expenses. For example, if you have a sale and the cost linked with those sales, those products, you didn't pay the cash to your suppliers because your suppliers provide you credit line. However, because you recognize the revenue in your income statement, you have to put the expenses into the income statement, even you didn't pay it. That's called matching principle. Here is one example of the income statement. So for this OZ company, in 2007, it has the sales 1,509 million. And then we subtract the cost of goods sold. And then we subtract depreciation. We can get this so-called earnings before interest and taxes. And this is the earnings before we pay interest and taxes. Then we put this, deduct the interest payment to the debt holders. Those are taxable income. And then we pay tax. We get net income. And we pay dividend to the shareholders. What is left is return the earnings, contribution to return the earnings. Here, you should know is that depreciation is only an accounting method. It's not an actual cash outflows. So in the expenses, those cost of goods sold are usually cash outflows. Those are costs you spend to buy raw materials linked to those net sales. And interest paid, those are interest payment cash outflows to debt holders. And the tax are cash outflows to the government. Only thing that is not a cash outflow is the depreciation. It's only an accounting number. Common size income statement is just like a common size balance sheet. The only difference is that we represent each item as a percentage of total sales. So the sales here is 100,000, and we divide it by 100,000, which is itself. We get 100%. Then we found that the cost of goods sold is 50% of sales, and the gross profit is 50% of the sales. The sales, general, and administrative expenses is 10% of the sales. So we found the operating profit is 40% of the sales. The tax divided by this 100,000, we found is around 8.4% of the sales. And finally, we found the net income is 32% of the sales. One practice, oil field services has net income of $120,400 US. It gives you total assets, total equity, and the total sales. Then what's a common size percentage for the net income? Here you should know that the common size percentage for net income is based on total sales, not total assets. We should divide the total income by total sales. So it's 7.91%. So first practice, Walmart stores has net sales. It gives you 2,000 cost of goods sold, depreciation, interest payment, and tax rate. Then let you find out the net income. So we just prepare an income statement. Net sales is 2,000. We minus the cost of goods sold minus depreciation. That's earnings before interest and tax. We minus the interest, which is taxable income. We can calculate the tax, which is 30% of the taxable income. So then we deduct it from taxable income. We get this net income, which is 777. And then we construct this common size income statement. We find out that cost of goods sold is 40% of the net sales. Depreciation is 2.5% of the sales. And then earnings before interest and the taxes will be 57.5% of the sales. Interest paid is 2% of the sales. Then we found the taxable income is 55.5% of the sales. Finally, we found out that net income is 38.85% of the sales. Next practice. Austin Co. has a net sales. It gives you net sales, cost of goods sold, depreciation, interest payment, and tax rate. And let you find out the next net income, which means you should construct an income statement. So net sales minus the cost of goods sold minus depreciation, that is earnings before interest and the taxes. So it's $1,580 minus interest paid, that's taxable income. Taxable income times the 15% tax rate. So we find out then deduct those taxes from taxable income. We find out the net income is $1,330. The common size income statement, we divide all the items by the net sales. So this is how we do it. Last, I would like to emphasize the depreciation. So suppose that a firm purchases a fixed assets of $5,000 and pay in cash. This $5,000 is a cash outflow at the time of purchase. And instead of deducting this $5,000 as expenses, an accountant may depreciate the assets over a 5-year period because this fixed asset, probably it's equipment, can be used for 5 years. So the useful life is 5 years. If the depreciation is a straight line and the asset is written down to 0 over the period, so each year the depreciation will be 1,000. This 1,000 is not a cash outflow. It's just an accounting number. The actual cash outflow, $5,000, occurs when the asset was purchased. So the depreciation deductible is just another application of the matching principles. The revenue associated with an asset would generally occurs over some length of time. So the accountant seeks to match the expenses of those assets with the benefit produced from it. So that's the income statement. Thank you for watching.